Many experts are saying the signs are flashing red. But what does it really mean for your investments? Let's break down the data you need to see before it's too late. This isn't panic. This is about understanding risk, patterns, and what history can teach us. The stock market has always been cyclical. Booms are followed by corrections, and corrections sometimes become crashes. In 2008, the global financial system nearly collapsed. In 2020, the pandemic triggered a sudden market shock. Today, some analysts are warning that we may be entering a period of heightened risk again. But this time, the environment is different. High inflation, rising interest rates, over-leveraged corporations, and unprecedented stimulus measures all interact in ways that make predicting the next downturn more complex than ever. Let's start with the macroeconomic picture. Inflation remains elevated in many parts of the world, prompting central banks to raise interest rates aggressively. Higher rates slow economic growth by increasing borrowing costs for businesses and consumers alike. The yield curve, a historically reliable predictor, has inverted, meaning short-term rates are higher than long-term rates. This inversion has preceded every US recession for the past 50 years. When money gets more expensive today than in the future, it's a sign investors expect economic slowdown. Next, consider corporate earnings and valuations. Many major tech companies are trading at historically high price-to-earnings ratios, while earnings growth has started to slow. Overvaluation is particularly dangerous in speculative sectors, where investor sentiment can shift quickly. Companies that look invincible on paper may face sudden corrections when revenue projections fail to meet expectations. Markets aren't just numbers, they're driven by human behavior. Right now, retail speculation is at a fever pitch. Meme stocks, crypto rallies, and leveraged ETFs indicate extreme optimism. History shows that when retail enthusiasm peaks, the downside can be swift and brutal. Fear often follows exuberance, and it spreads faster than most investors expect. On the global stage, geopolitical tensions, energy crises, and supply chain disruptions all increase the potential for market shocks. Liquidity conditions are also tightening. Rising debt levels, record margin debt, and shrinking liquidity can amplify volatility. When markets lack depth, even small triggers can cause outsized moves. Looking at technical indicators, we see heightened volatility in major indices, resistance at historical highs, and increasing spikes in the VX, the so-called fear index. Historically, these warning signals often precede corrections, even if timing is unpredictable. Smart investors watch these metrics to adjust risk exposure proactively. So, what does this mean for your investments? The goal isn't panic, it's preparation. Diversification, risk management, and understanding the macroeconomic and psychological context are more important than ever. Investors who pay attention to these signs can position themselves to weather downturns, protect capital, and even capitalize on opportunities that arise in volatility. The truth is, no one can predict the exact timing of a crash. But history, data, and market psychology give us clues. Smart money doesn't react blindly. It anticipates, adapts, and plans. By understanding these warning signs, you give yourself an edge over the majority who only notice the red flags after they've already hit. If you found this breakdown helpful, subscribe to Vaultrax for more insights into business, investing, and the psychology behind money. Share this video with someone who wants to think like a smart investor before the market makes its next move. Knowledge is the real advantage. Don't leave it up to